Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first Dell projects $50 billion in AI server revenue, fueling a memory shortage that is crushing PC rivals and driving up consumer prices. We'll analyze why this market split is a turning point and how it affects PC pricing and Dell's dependence on Nvidia's supply chain. Second, Samsung sidesteps responsibility for the deepfake crisis, calling it an industry problem while its own phones can easily erase AI watermarks. In this episode, we'll break down the company's passive stance and what it signals for the future of photographic evidence and digital trust ecosystems. Third, as AI disruption panics the $2 trillion software market, Goldman Sachs thrives by using a proprietary risk framework to avoid vulnerable investments. So we'll discuss why Goldman's contrarian strategy matters and what it means for investment playbooks in the era of AI-driven software disruption. Fourth, NASA's Artemis III moon landing is scrapped due to SpaceX delays and safety risks, pushing a lunar return to 2028 in a tight race with China. We'll examine how this major setback may impact the timeline of the 21st century space race and the sustainability of NASA's $93 billion program. Fifth, the new Trump T1 phone appears to be a rebranded, underperforming HTC model, raising questions about its flagship claims and premium pricing. This discussion will reveal how the ODM business model enables this and what it means for consumers paying premium prices for mid-range hardware. Let's start with a single statistic that might just change your entire perspective on Dell. The company's stock just surged over 22% in one day, and it's all because of this number. They're projecting their AI server business will hit a staggering $50 billion in revenue by 2027. Dell's total revenue forecast is now between $138 and $142 billion, completely blowing away the $124 billion expected by analysts. This isn't just about selling more computers, it's about capturing the foundational infrastructure of the AI revolution. A while back, we walked through how the tech giants are trapped in a prisoner's sway dilemma spending race, hundreds of billions pouring into data centers, and how sovereign AI is turning entire countries into bulk buyers of Nvidia chips. That's the demand engine under Dell's guidance, and it hasn't let up, but that's not the whole picture. The real turning point is that this AI gold rush is happening in the middle of a historic memory shortage. The high bandwidth memory needed for AI chips from companies like Nvidia and Google is being prioritized, creating a supply chain crisis for the makers of laptops and smartphones. So the thing is, major memory manufacturers, we're talking giants like Samsung and SK Hynix, are shifting their production lines away from standard computer memory or DRAM to focus on high bandwidth memory or HBM. They're doing this because HBM is what AI chips need to process massive amounts of data at incredible speeds. It's like the memory makers are diverting all the water from a river to power a massive new factory, leaving everyone else high and dry. We previously labeled this the AI tax and flagged that AI data centers could soak up as much as 70% of high-end memory by 2026. We even noted reports of ByteDance seeking bundled HBM and DRAM guarantees from Samsung, a preview of the pre-booked capacity that's now starving PCs and phones. And this shortage is absolutely crushing the competition. The situation presents a fascinating duality. On one side, Dell's stock is soaring to new highs, while on the other, its direct rival HP saw its shares hit a 52-week low. HP's own CFO admitted their memory costs have risen roughly 100% sequentially, now making up 35% of a PC's total cost. That's double what it was just a year ago. Just last quarter, memory was only 15 to 18% of a PC's cost. This is the direct consequence of that HBM priority shift we just talked about. It mirrors what we called out in handsets a while back. Average selling prices jumping 14% to a record as companies pass costs through, and IDC projecting a 12.9% plunge in smartphone shipments next year. The squeeze started in phones. Now it's rolling straight into PCs. So what is Dell's secret? It's a high-stakes gamble. The company's CFO confirmed they are actively increasing prices on their PCs to offset the pressure from these surging costs, betting that customers will simply pay more. As we've said before, that's the AI tax landing on your receipt first phones, now PCs. However, if you zoom out, you'll see another layer of strategy at play, and it comes with inherent risks. Top analysts are now raising concerns, with one stating they are unsure of the demand elasticity created by the swift and significant price actions taken by Dell. In other words, these aggressive price hikes could backfire and destroy future demand. This is a direct echo of what we saw between 2016 and 2018, when a similar memory shortage led to rising PC prices and a drop in consumer demand. Some analysts now predict these new price hikes could cause a 10% decline in PC shipments by 2026, and the playbook is familiar. Remember when the 2011 Thailand floods erased 30% of hard drive output and PC shipments created 20%? Today's memory shock is a rhyme of that history, and IDC's 12.9% smartphone shipment drop projection shows how quickly demand can buckle when components get scarce and prices spike. This is a dramatic split in the tech world. As the AI boom creates a component famine, Dell is betting billions that it can have it all. But what's crucial to understand is that Dell's incredible AI server growth is almost entirely dependent on getting enough GPUs from Nvidia. This makes Dell in many ways a high-volume assembler for Nvidia's technology, not a primary innovator, which exposes them to huge risks. If Nvidia decides to raise its prices or tighten GPU allocations, Dell's profit margins could get squeezed hard. A few days ago, we mentioned reports that Nvidia is exploring a multi-billion-dollar stake in OpenAI and raking in tens of billions from sovereign AI proof that Nvidia isn't just selling the shovels, it's also taking a stake in the mine. In a market where hyperscalers can't stop buying without falling behind, that only concentrates power further with Nvidia. So while Dell is winning today, the ultimate power in this supply chain still sits with Nvidia. Speaking of hardware giants navigating the AI boom, Samsung, one of the biggest names in the game, was just put on the spot about a very different kind of AI problem, the deepfake crisis. As the world's second largest smartphone maker, Samsung puts millions of cameras into our hands. So when their top executives were asked how they plan to stop AI from destroying the concept of photographic evidence, the industry listened, but they didn't have any new ideas. Instead, Samsung's mobile COO, Wonjun Choi, said the company needs to balance photographic reality with letting users be, quote, more creative. He called the erosion of reality a problem, but one that needs to be solved at an industry level, passing the buck to a broader conversation. Now, this idea of an industry level problem is significant. There's actually a coalition called C2PA that created a standard to embed a kind of digital birth certificate into photos to prove they're real. But here's the catch. Major social media platforms like Instagram, Facebook, and TikTok automatically strip that proof away when you upload a picture. They do it to save space and for other technical reasons, but the result is that any effort to verify photos is basically erased the moment you share it. So Samsung is pointing to a very real systemic failure. He then pointed to Samsung's current solution, a simple watermark on AI-generated images, a watermark that can be easily removed. And believe it or not, research shows you don't even need a special app to do it. On Samsung's own Galaxy S24, the built-in object eraser tool can be used to wipe away the AI watermark, and the phone won't even add it back. The very tool meant to signify AI's involvement can be defeated by another tool on the same device, making the watermark almost meaningless. This is where the situation takes a more complex turn. When another reporter asked if Samsung might make it even easier for customers to remove that AI watermark, an executive didn't rule it out. He said if consumers want that ability, the company will deliver the best of what people are wanting. But the most jaw-dropping moment came from Samsung America's SVP of Mobile Product Management, Drew Blackard. He suggested that our negative feelings toward AI-generated content might become, quote, more favorable in the future. He compared the deepfake crisis to early skepticism about user-generated content, suggesting our perception of reality might just change. That comparison, however, is deeply flawed. User-generated content, like a video from your friend's vacation, is rooted in a real person's experience. That's why we trust it. In fact, studies show that 86% of people trust recommendations from real individuals. But AI-generated content, it's made by an algorithm with no connection to reality. The same studies show that only 19% of consumers trust AI-generated content. So comparing the two is like comparing a personal diary to a computer-generated novel and saying they're the same thing. They are fundamentally different. While the line between real and fake evaporates, the message from one of the world's most powerful tech companies is clear. They're framing the issue not as a social responsibility, but as a balancing act for business, a matter of creator choice. The official position seems to be that as AI blurs reality, the solution isn't to fix the technology, but for society to simply get used to it. And what's wild is that this isn't the only way to approach it. Apple, for instance, is embedding invisible metadata into its AI images to signal they're machine-made, leaning into technical standards rather than just shrugging. It shows that authenticity can be a competitive feature, not just an industry problem to be ignored. While some companies are taking a passive stance on AI's challenges, others are playing offense. In the $2 trillion software market, fears of AI disruption are causing a panic, but one Wall Street giant is telling a completely different story. A while back, we walked through why this fear isn't abstract. Mistral's CEO said more than half of enterprise software could be replaced by AI, and we highlighted real-world proof when Klarna scrapped roughly 1,200 SaaS tools for its own AI platform. We even called that sell-off Software-mageddon when the software index cratered in a single week. Today's panic is the same story, just at a bigger scale. The core issue is that the private credit market has become heavily concentrated in software loans. Over the last decade, exposure has ballooned, with some estimates showing software-related investments now make up between 16 and 31% of some major portfolios. That's a massive bet on a single sector, and now AI is threatening to pull the rug out from under it. The panic is real. In just 1 month this year, AI competition wiped an estimated $2 trillion in value from the software sector. As we noted a while back, that pressure is hitting especially hard where AI can rapidly replicate workflow software, the task-specific tools that are easiest to replace. But while the panic spreads, Goldman Sachs is not only bucking the trend, it's defying it. While competitors are seeing investors pull their money out, Goldman's private credit arm is reporting strong appetite. Its redemption rate in the fourth quarter was just 3.5%, while its peers saw rates over 5%. And December inflows for Goldman were 11% above the year-to-date average. We previously analysed broad outflows from funds tied to vulnerable software names. The latest development is that Goldman's flows are moving in the opposite direction. The key to their strategy, they saw it coming. In a letter to investors, the firm revealed it has been assessing the impact of AI on software for years and even passed on its first deal due to AI concerns all the way back in October 2023. While others are now scrambling, Goldman has been operating on a different playbook, keeping its exposure to enterprise software credit toward the low end of the range for its peers. Continuing our last discussion on where AI bites first, that stance lines up with avoiding the most exposed workflow categories and being far choosy around defensible core systems. The firm acknowledges the danger, stating it agrees that AI will lead to increased competitive intensity for incumbent software companies, but its strategy is to focus on businesses with structural advantages and incumbency moats that new AI-powered entrants will find difficult to displace. When we place the AI threat alongside Goldman's strategy, the importance of these so-called moats becomes clear. But not all moats are created equal. Some are already crumbling. We're seeing AI-native competitors erode the value of traditional software like CRM systems, with companies like Salesforce seeing massive stock drops. Even creative giants like Adobe are under pressure. The strong moats Goldman is looking for are different. They are found in software that is deeply embedded into a company's critical daily operations, has high switching costs, or serves highly regulated industries like healthcare, finance, or energy. A while back, we drew the line between systems of record, which are harder to rip out, and workflow software, like e-signature or project management, that AI can replicate at speed. The market has already marked those down. Think about complex compliance or specialized curated data sets that an AI can't just scrape from the internet. That's the safe harbor in this storm. This isn't about ignoring the risk. In their own words, Goldman Sachs flatly stated, "We do not underestimate the risk of AI disruption. This is a story of a financial heavyweight that built its own internal framework to evaluate AI risk in early 2025, preparing for the storm, while its rivals are just now feeling the first waves." And remember, as we discussed, when Claude's massive context window started automating IT tickets and code migrations, the pace of change is exactly why a forward-looking risk screen matters. Internally, these frameworks systematically quantify the danger by asking tough questions. How essential is this software to the client's core business? Does the company have unique proprietary data that new AI tools can't easily access? And does it have the financial strength to invest in its own AI integration to stay ahead? This maps directly to what we outlined a while back. The winners own irreplaceable data and mission-critical workflows. The rest are priced like they're standing on sand. This is the playbook for survival, and Goldman has been using it while others were still chasing the last tech boom. We were just talking about managing high-stakes financial risk. Now, let's shift our focus to perhaps the highest stakes of all, human spaceflight. NASA just announced its mission to land humans on the moon is no longer going to the moon. And this isn't just any trip. The whole point of the Artemis program is to get to the lunar South Pole. That region is believed to be packed with water ice, a resource that could be used for life support and even rocket fuel. It's the strategic high ground of the 21st century space race, and everyone from the US to China and India is targeting it. In a radical shift, the Artemis III mission has been completely retasked. The issue boils down to a key piece of hardware for the actual landing, the human landing system, which is being built by SpaceX. It's a version of their massive Starship rocket, and it's just not ready. SpaceX has had multiple test failures, and NASA's own internal assessments projected a 30% chance the Starship lander wouldn't be ready until after early 2028. Instead of a moon landing, it will now be a technology test flight in low Earth orbit, pushed back to mid-2027. The human moon landing is now pushed to an entirely new mission, Artemis IV, tentatively scheduled for 2028. This delay is significant because the new date puts NASA in a direct horse race with China. China has been making steady progress, with successful tests of its Mengzhou crew capsule and a stated goal to land its own astronauts on the moon by 2030. With this delay, the question of who gets back to the moon first is suddenly wide open. And if that was just the appetizer, the main course is the staggering cost. According to NASA's own Inspector General, the Artemis program is projected to cost taxpayers around $93 billion through 2025. Each individual launch of the SLS rocket, the one that gets the astronauts into space, costs an estimated $4.1 billion. $4.1 billion per launch. What really brought this to a head was a blunt report from an independent safety panel sharply criticising the space agency's plans as too risky and calling for an urgent revision. Now, even the precursor mission Artemis II, which is supposed to fly astronauts times the moon without landing, is being pushed back again to April 1st at the earliest. This follows the discovery of a blockage in the rocket's helium flow just weeks after a previous launch was scrubbed due to a hydrogen leak. NASA Administrator Jared Isaacman went on the record with a statement that reveals everything about this new direction. And to understand this statement, you have to understand who Isaacman is. He's a commercial astronaut and entrepreneur who flew on private missions. His whole background is in the faster, leaner world of commercial space, and he has a blueprint called Project Athena that's all about using fixed price contracts to push private companies to innovate faster. He told reporters, "We've got to get back to basics." The agency is now adopting an evolutionary approach, adding extra flights to test systems and reduce risk, much like the missions that preceded Apollo 11. When we place Artemis's $93 billion price tag alongside the Apollo program's cost of around $257 billion in today's money, the cost per mission for Artemis is dramatically higher, raising serious questions about how sustainable this step-by-step approach will be in the long run. After aiming for a giant leap back to the moon, NASA is now responding to technical failures and stark safety warnings. The return to the lunar surface is once again being built, not with a single massive jump, but with a series of smaller, more cautious steps. Speaking of hardware not being quite what it seems, the story of the new Trump phone, the T1, begins with a design that looks suspiciously familiar. Mounting evidence suggests it's a 2-year-old unpopular HTC phone in a new shell. The similarities are uncanny. The T1 and the HTC U24 Pro share a near identical design down to the same sharply angled body and curved display, but the most telling detail is a unique 3-part sensor array above the screen, a design so specific it's hard to dismiss as a coincidence. The similarities don't stop there. Both phones feature a headphone jack and a microSD card slot, 2 features almost extinct in the modern smartphone market. Interestingly enough, the inclusion of these features isn't just a random choice. It might be a deliberate signal. Remember when Apple removed the headphone jack in 2016? There was a huge backlash from people who saw it as a push towards expensive proprietary accessories. By including a headphone jack and expandable storage, the T1 positions itself as a kind of anti-Apple, anti-big tech device. The question is whether this is a genuine design philosophy or just a cosmetic feature that came with the pre-made design. So is HTC secretly building the Trump phone? The company issued a direct denial stating, HTC does not design or manufacture phones for third parties. This points to a different story. one that happens behind the scenes. The most likely scenario involves an original design manufacturer, or ODM, and understanding the ODM model is key, as it's the secret engine of the entire smartphone industry. These are ghost factories that design and build hardware for other brands, and they often reuse their designs for different clients. They own the intellectual property for their hardware, allowing them to legally sell the same basic phone to multiple companies. You might think this is rare, but it's the norm. Research shows a staggering 90% of Motorola's phones are ODM based. For Xiaomi, it's 78%. Even Samsung still relies on ODMs for over a quarter of its phones. So the idea of a phone not being truly original isn't a scandal. It's just business as usual in the mid-range market. This connection raises major questions about the T1's flagship credentials. The HTC U24 Pro, it appears to be based on, was a mid-range phone that launched in 2024 to brutal reviews. One major tech publication gave it 2.5 stars out of 5, calling it hard to recommend over rivals. Another declared it modern and yet out of date. Now, get this. Calling this phone mid-range isn't just an opinion, it's a technical fact. The HTC phone was built around a Snapdragon 7 series processor. A true 2024 flagship phone uses a Snapdragon 8 series chip. The performance gap is massive. Benchmark tests show the mid-range chip has only about 41% of the multi-core processing power of a real flagship chip. So you're potentially paying a premium price for less than half the performance. While the final specs for the T1 could differ, the core design appears to be a direct copy of a device that critics already dismissed. The T1 is being marketed as a premium, cutting-edge device, but its origins are tied directly to an unpopular mid-range phone from 2 years ago.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.